The one interesting trend over the last couple of months has been that mutual funds have started getting money once again. You will recall that last year there was a net outflow from mutual funds, a situation which was compounded by the distribution norms which came in. But as 2010 has opened up, we are seeing at least one NFO having raised quite a bit of money, and even existing funds getting a trickle, and now that trickle is becoming a little bit more of a inflow pipeline into equity mutual funds. Rajiv Anand, CEO of Axis Mutual Fund, joins in to talk about this and whether it's beginning to look like a trend. Morning, Rajiv. Thanks for joining in. What's your sense? Is it just a one-off, or has something really changed after the complete stalemate of last year?
I think one would have to look at last year, sort of in conjunction with what happened in 2008, the entire panic and the impact on investors. I think what we are now seeing is post the change in the rules as far as entry load, etc., is concerned on 1st August. I think clearly we are seeing net inflows into funds on a regular basis. January saw a couple of large NFOs being allotted, including ours. But what is actually particularly satisfying is the fact that we are also seeing money coming in on a daily basis, and that's pretty much across the country. So to that extent, I do believe that a couple of things have happened in the last couple of months. One is a couple of NFOs being allotted. Two is there's been some smart money coming in on this correction of 10 to 12%. And three, I think you are seeing the distribution community beginning to realign to the new rules and regulations, and therefore whether it is the banks as distributors or the smaller IFAs, I think the fact that the equity mutual fund product is probably the cheapest and the best and most efficient long-term savings product, I think is beginning to sink in. But I mean, let's put it in perspective. I think we've got a long way to go, and I sincerely hope that this is the beginning of a long-term trend.
Rajiv, morning. Would you have a handy reference on numbers in terms of what total inflows stand at from Jan to now, and how that's split between NFOs and existing funds across the sector?
If my memory serves me right, I think it's about 3,000 crores in January and February is the net inflows into equities, and I think about 1,500 to 1,600 crores would be through NFOs, and the rest would be ongoing sales. And this is a net number. What is also heartening is you're also seeing a fair amount of money, and this is not the last 2 months trend, but over the last 6 to 8 months, you are seeing money coming into hybrid products, typically with 70-80% in fixed income, 20-25% in equities, and those products are certainly seeing a fair amount of traction, and that is also bringing in some element of an equity component.
What was your own NFO about, Rajiv? I mean, was it vanilla diversified? Was it sector specific? What was it about?
Axis Equity Fund, our first equity fund, was a diversified equity fund with a focus on large cap, which we define as 10,000 crores and above, where 70% of the money goes into large caps and about 30% goes into mid caps, and that in a sense becomes our flagship fund.
Is there any switch happening, Rajiv, from fixed income products to equity products? Because fixed income funds apparently have lost some money, have seen some outflows, and equity has benefited. This is not a fixed income to equity shift in part because of what's going on in the interest rate front, is it?
I think that shift is a little difficult to discern. I'm really not sure. But what is clearly discernible is the fact that there is not a lot of money coming into long-term bond funds, especially in an environment where optically at least interest rates are or inflation is in double digits, and interest rates are expected to go higher. But I think the total of about 3,000 odd crores is still too small to say that there is a shift in asset allocation between fixed income and equities. But what we are perhaps seeing is new investors coming into the mutual fund route. One first through the hybrid funds or monthly income plans as they're called, and then there are some investors who are going one step up the risk-reward matrix and buying into equity funds as well.
Which of these two factors is the more important one? I mean, do you think it's a market call for which investors are getting in? Because that typically tends to be the case when people find more comfort about limited downside and some upsides going forward. Or do you think that people have come around to accepting the changes on the distribution front and it's that coming to terms which has been the bigger factor as 2010 opened up?
I think I would imagine that it's a little bit of both, Udyan. I think one of the issues that we had in 2009 was the fact that a lot of investments out of 2008 was usually out of the money for quite some time, and as NAVs got closer or beyond their purchase price, they retail investors started to redeem. So one factor is the fact that redemptions to that extent have reduced. Two is as the markets and like you said, the distribution community has begun to work in this new environment. We are seeing new inflows from new distributors as well. And three, of course, the so-called smart money has sort of taken the benefit of this correction and has got into the markets as well.
There were some fairly large changes in announcements by SEBI yesterday, Rajiv, with relation to NFOs in terms of duration, in terms of how soon the money can be pumped into the market, etc. What did you make of those observations?
I think most of those are often operational in nature. At a very broad level, I don't think we have too much of an issue in terms of any of those regulations that have come through yesterday. For example, in terms of the NFOs itself, the total time, which is today 30 days for mutual funds, that's been reduced to 15 days. The use of ASBA has been mandated as far as mutual fund NFOs are also concerned. I think to that extent, mutual fund NFOs are being brought closer to equity IPOs, and I think given the fact that retail investors are broadly quite comfortable in terms of utilization of many of these facilities in equity IPOs, I don't see too much of a problem as far as equity NFOs are also concerned. The only perhaps one issue is that given the fact that it takes quite a bit of time for us to market the NFO, 15 days is probably a little too, is not very comforting, given the fact that we are quite used to a 30-day time frame. And remember, unlike an equity IPO, equity NFO is a bit of a push product, so it takes a little bit of time for you to push into deep into this country. So, but I'm sure we'll manage that.
Good speaking with you, Rajiv. Thanks for stopping by. Good to hear there's money coming into the MF industry as well. Let's take a break on that.